Chris, I was saying there, this general mood of optimism, something of a turning point, or at least a stop of panicking at any possible negative signal in the last week or so.
No, I think so, and I think you also have seen it with the mood around US jobs numbers. You've just seen it's really just been 3 data points, 2 weekly claims, and the actual monthly jobs number that came out last week, and that's helped to boost the mood. And I think in the wake of the ECB's thing, the Draghi said nothing at the conference, the markets caved in, and then you realise maybe there's something in the background that's going to be coming through.
Yeah, and the view seemed to be that once the news was digested, once what he said was digested, he got vocal support from others.
Yes.
It appeared that this was not just a chance remark, that there was something behind it.
Well, we need to just still see
what
some
the action
time,
is.
because he's been making these statements at a time the markets have been heavily oversold, so you needed a bounce anyway. Now we need to see some extension on that bounce just to see if there's something genuine, or whether this will just turn around and actually test their resolve again.
One of the English commentators said this is a radical policy shift. The markets need to understand that this is a radical shift because they've shown willing.
They're showing they're willing in word still, but we still have to get the deed. The ESF, for instance, is a fund that still has to be formed. For example, and there are divisions within the ECB in terms of what the Germans...
Well, it all seems to come back to Germany.
Or the Italian or French lenses are looking at the world very different.
And what about our Aussie? Before we look at some of the results that came out this week, generally, almost every day there was a new record high.
No, I think we need to appreciate that. It's a term that I use called differentiation. It's not decoupling. You can see the when the world economy slows down, everybody slows down, and the same goes with markets. The correlation is quite strong. But the actual trends are very different. And as the European markets bounce off very deep lows, we're setting new all-time highs. And we're not the only ones setting new all-time highs. It's also Thailand and Indonesia and Colombia, and that kind of, it's not the BRICS, funny enough. It's what we would call the second tier emerging markets that are actually reflecting that strength. And basically, when you've got yields in negative territory, in other words, not just negative from a real point, in other words, from an inflation point of view, but negative in absolute terms because of the sheer panic as money is shifting from Southern Europe to Northern Europe. You're sitting with now yield curves that are sitting in negative territory. That is just sheer desperation. At some stage, that money is going to be shaken out, looking for growth, yield, solvency, and that, just in relation to our bonds, I think there's still more money that's going to come in for bonds. That'll, of course, help the property sector. It'll help the retail sector. It'll help the rand. If
when you say help the rand, it'll make it stronger.
Stronger, yes, exactly. And that you just see strength in the rand, more inflows, etc., on money, looking for growth, looking for yield, etc. You may well find that the central bank here comes with another interest rate cut, and that means that the strength of the retail sector will continue to be underpinned. So these things that are, that look such expensive value will keep going, but our bonds will keep going. Our properties, listed property sector will keep going.
Our banks?
And our banks will also maybe start to...
Because what Mark Wayner was saying there earlier, they're redeveloping all these properties, the upmarket properties. They're looking at a consumer spending that's not going to give up.
You may well find, I'm not sure if it's completely the right thing for us to have cut rates, because we may be seeing a consumption boom, not necessarily an investment boom. But where that consumption is being concentrated, you are getting some investment into infrastructure, so it's shopping centres, that thing. You have to, though, project yourself in 2, 3, 4 years' time, when that cycle then gets overspent. You then sit up with an excess of retail space and that kind of thing. But that's a problem for 2 or 3 years hence.
Yes. Looking at the markets today, I mentioned earlier, Goldfields was up now by over 3.04%.
What was interesting is that...
all the gold ones up.
No, exactly. What was interesting is that the actual gold price was also up when the equities were down. So you saw a bit of how can you say, that contrary safe haven play. And that's the enigma about gold, is that it sometimes looks like a risk asset. In other words, when the shares are going up, the gold price is also going up. But today it was actually behaving in a contrarian sense, which is what you want, a decorrelated asset, which is what one needs from a risk management point of view.
And the platinum shares as well have shown some life.
Exactly. I don't think one can just ring fence just gold. I think that's the precious metals as a group, but gold is quite important.
Looking at a couple of the big financial companies, Old Mutual reported this week, and yes. I think the consensus was that Old Mutual has sorted out its problems and is set for growth. If you looked at their share price in 1 year, it's gone from 12 Rand to 21 Rand.
Exactly. Old Mutual had an enormous amount of embedded, if they like to use the term embedded value, but I think it was a call of suppressed value, or value that was there that just needed to be released once people are satisfied that they've actually got a coherent business strategy that you can say will work. I think they've gone through a number of, let's call it, misadventures over the last few years, trying to play a huge global player, and they never stuck to their knitting. In other words, they didn't reinforce their strengths and anchor their home markets and that kind of thing. Now I think they're starting to do that, and it's starting to show. They've paid down debt, they've got rid of what I call distractions, and that kind of thing. It's a problem when you're sitting in London. You see the world differently from sitting in Johannesburg. And I think that was Old Mutual's problem, is that it was sitting in London trying to play a global play with its major asset base in Rand. And there's a bit of a mismatch.
It was also interesting, just noted again this week, that a third of its assets are Nedbank.
Yeah, exactly.
It's a big part of it.
And they're trying...
Just as well they didn't get rid of it.
Exactly. Not only that, you don't know what the longest term strategy, are they going to sell it? Okay, yes, there is a buyer. Okay, no, we're not going to, it fell through, etc. But we know it was potentially on the chopping block. But I get the feeling if they actually start to refocus and see where their strength is, they will not get rid of Nedbank.
Well, it depends what your business is. If your business is financial services, keep the bank and keep the insurance company.
Yeah, exactly.
Well, thanks, Chris. We have to stop
pleasure.
there. That was Chris Hart, Chief Strategist at Investment Solutions.